Welcome to this week's edition of Cattle Call. I'm Susan Littlefield. A variety of things we're going to talk about. I think one of the most interesting thing is we're going to look at markets from a year ago, January 20th, 2020, to what we see January 2021. That's where we might actually start the conversation, because I think that's going to kind of feed into what we're seeing in the markets elsewhere. As you see on the screen, Brad Kooima is joining us. He is with Kooima and Varlick out of Sioux Center, Iowa. So let's do that comparison. You look a year ago to where we are today. I mean, there's been some nice increases in the dollar amount.
Well, Susan, I think it's an interesting thing to look at, just because I looked at it this morning to try to give my own self some perspective. Often whether you're a cattleman or a cattle trader, or especially I think sometimes if you're a broker, it's easy to get caught up in the here and now. You get asked the question, well, what's going to happen today? And I get it. People want to, have the idea of what we think the here and now is all about. But, actually, I really believe that at least I am a much better trader and an analyst if I try to look at a little more of a longer view, and then try to bend that into, short-term trading strategies. So to your point, this morning, I thought, okay, January 20, a year ago, the world changed a great deal since last year on January 20. So I just looked for fun to see where our marketplace was. I know where the box beef was. It was about the same price as it is now. I also know that the cash market was about 120 to 122 last year at this time. Much different than it is now in terms of the packer margin. Don't forget, of course, January 20, a year ago, most of us, me included, were still in denial over the severity of COVID. It really wasn't until about the third week of February that our market started to really suffer. And so last year, October cattle settled at 118.82, the October contract for 2020. This year it's 120.20 today, so it's about $1.50 difference. Last year, December cattle 121.42, and now it's 122.85, about $1.50 premium, higher. Okay. And I get an awful lot of guys that are saying, and gals, and saying, well, boy, the back months feel kind of high, don't they? And I'm going like, they're high compared to today's cash bids maybe, but I really don't think they are. If you take a look at that macro, a little bit of a historical perspective, just look at last year, what we thought we knew. We've got, I think most fundamental analysis would agree. I don't know if they don't, whatever. I think strongly that there's less cattle in the fourth quarter this year than there was what we expected to have last year. Less cattle this year compared to last year. Okay, corn's up at least $1.50 from what it was a year ago at that time. I think everybody generally expects that higher price feed leads to less beef production because of less weight, right? Thirdly, and maybe most importantly, we're talking about the fourth quarter of next year. I would certainly hope that we could have the majority of the COVID influence behind us. We would either have enough vaccinations, or there's going to be, enough maybe herd immunity, if you would, and hopefully you would be into the fourth quarter with a more relaxed, better hotel restaurant, situation. So, I just to put it in perspective, I think the back months have some value, and obviously we don't necessarily have to gauge everything about what Brad thinks December cattle ought to be worth, but I think just putting it in perspective, this market's gotten itself terribly distressed, and I think that the cattle market deserves to have some improvement, and significantly so.
Hindsight's 2020. Are we focusing too much on COVID and what it's done, and not looking at what's coming up and cattle going into the feed yards and grain prices?
Well, I think that's an interesting question, because I think yes, in a couple of different ways. I think yes, because uncertainty does not build confidence in the commodity trader. Okay, first of all, and the market needs the long speculator. Whether anybody thinks that or not, I'm convinced that the market needs the long speculator. You can't make every rule to benefit the hedger or the commercial, the packer, right? You also have to have some incentive for the guy to take a chance and say, you know what, I think it's going higher. But so with all that uncertainty that COVID created, we're struggling to fill that sector back in. That maybe is a thought for another day, because our open interest is so small that if they do come back, they've got some bullets in the musket now, I'll tell you what. But the other part of that deal, though, is the uncertainty that's created in the fundamental style of the market too. I mean, so if you're a restaurant, are you going to buy a whole bunch of stuff extra ahead? No, you don't dare to. If you're Fairway, are you going to stockpile the stuff when you don't know exactly what you can expect in terms of demand? So those things all play into that, and I'm hoping that latter part of that deal could actually work in our favor, Susan, because you could have, what if demand is a little better than expected? It's been better than expected the last 3 weeks. Look at the box beef, trades great. Demand's really good. Don't let anybody fool you. So what then when you got a whole industry that's hand to mouth? You actually could maybe surprise them and have the stuff move a little higher than they thought it would have.
And it's nice to see the kill levels where they're at right now.
Very much so. We've done a great job of killing cattle here the last while. We've done a particularly good job here in the last month or so, year to date, the short year that we've had. It's been very, very good. I still am encouraged by the Choice Select spread hanging in there when we're putting a lot of choice into the mix. So some of that macro stuff is still positive. The river of crocodiles that we're not that we haven't gotten through yet, is that you got high price feed. You got a cost of gain that's probably higher than what cattle are worth, right? So you're going to have, cattle worth $1.10, your cost of gain is $1.15, $20, whatever, especially if you're in the South where corn's significantly higher than it is in Nebraska and Iowa. These guys are just going to turn in cattle. And that's going to, limit, restrict the packer. He's not going to have to try very hard. So, in the here and now, we probably have, or maybe not quite getting through a few of this crocodile river here that we got to deal with. But that typically short-term problems creates intermediate and long-term, better things. I think that's where we are. We're not on the other side of the river quite yet.
Well, we just need to keep swimming and see what the next couple of weeks and months bring.
It's going the right direction. I really like how the market feels down the road a little bit. But yeah, let's get ourselves current. Let's get on down the road.
All right, sounds good. Thanks so much for joining us this week, Brad.
You got it.
That's Brad Kooima. He's with Kooima and Varlick out of Sioux Center, Iowa. And just a reminder, commodity futures and options involve substantial risk of loss, and they're not suitable for all investors. That's this week's Cattle Call. I'm Susan Littlefield.